So when we speak about important investment principles and a strategy for an irrational world, well, why is the world irrational? Well, fundamentally, it's being run by human beings, and human beings are subject to all sorts of behavior modifications, sudden maneuvers, and that gets reflected in the market. And one of the things we understand about successful investing is regardless of how analytical you are, you still have to deal with basic human behavior. So successful investing, as I identify, being disciplined and methodical. So first and foremost, one has to understand what's happening in great detail. And I've gone into this in other areas where you strip away and assume no knowledge, don't have any bias, see the world as it is, not how you wish it was or how it used to be, but really understand and methodically apply the forces that you think will impact successful companies and therefore successful investments. So one has to do analytical work and study in detail the forces that really drive the system, as I describe it. What makes the difference? So for instance, in a lot of work that I've done in my computer science study, there can be maybe 30, 50, even 100 factors that influence things. And if you look at the market, you've got thousands and thousands of factors. But what makes the difference? What will actually change an outcome? And those tend to be very few. So while I'm saying go beyond a simple summary, it means that simply saying, well, there's this supply, this demand, this price, this outlook, and therefore the market will do this specific stock will do that. That is not what's really going on. There are certain factors that impact a very specific situation, and these are the things that we need to understand in greater depth. And so what's required? So when I say understanding global economics, one of the things that has happened over, let's say, the last 30 years is the impact of other countries makes a big difference in domestic markets. So we had Japan in the 1980s, we have China today, and one cannot ignore the competitive impact that global economies have. And so anybody doing business, even if you think it's a local business and people talk about having moats. By the way, there's no such thing as a moat anymore because situations are so dynamic that you really have to be dynamic and responsive. And the first thing to understand is, well, what is going on globally? Then, of course, the next thing is that a very specific competitive corporate, and I call it a micro level analysis. And micro level takes on many dimensions. It's not only economics that's applied to specific businesses. That's also when you look at what are the advantages, how are those advantages sustainable, how are they changing, what's specific, and who is running things. At a micro level analysis, at the end of the day, it's a team of people that makes things happen. And so if you don't understand the quality and experience and quality decision making, you really won't understand what's happening with any specific investment. And then when I think about game theory, it really is, it sounds very complicated. And of course, these are things where computer pioneers like John von Neumann developed these ideas. But the least complex component of game theory is, well, if you do this, what's the other guy going to do? And then what he or she makes decisions, what do you do, right? And it really is almost equivalent to a chess game. And one has to think moves ahead, but also one has to see the whole board. What's happening out there? And if I make these series of moves, if I assume that my competitor will make his next best move, what would that be? So for instance, one of the classic examples of game theory is in the automobile industry, where Henry Ford was dominating with the Model T, and he stayed with the Model T, and we win, we always win. But then General Motors came out, and Albert Sloan said, people probably want windows that close. They probably want more powerful motors, and they probably want heaters. And Henry Ford refused to change. And so the game theory there was Ford did not understand the best move from his competitor and refused to make that move. And then when his competitor made that move, Ford had to shut down for 18 to 24 months, and they came up with the Model A in competitive response. And they were probably forever disadvantaged against General Motors as a result of that. So game theory makes a big difference. And of course, the modern version is Blockbuster and Netflix. The Netflix service was well known. Blockbuster had the opportunity, but refused to make their best decision knowing what their competitor's best decision was. And so ultimately you have a winner, and that was competitively changed from now on. And one of the things that drives that, and we can't escape it, as I mentioned before, is human emotions and behavior. So regardless of what your analysis shows, it doesn't matter. What matters is what the market thinks. And John Maynard Keynes had a great description of this, where he said, if you're trying to figure out the winner of a beauty pageant, who you think is most beautiful just doesn't matter. It's who the judges think. So the market are the judges. They may be irrational, they may be making obvious bad choices, but that doesn't matter. They're still the decision makers, and you are not. And you're subject to the kind of human emotions and behavior that drive pricing. Everybody wants to buy something one day, nobody wants to buy it the next day, and it's fundamentally driving supply and demand, and that's driving prices, and that's driving the market. So that's why one has to think and be informed, but also have the perspective about what will happen. So the key components to any investment: predict the future. Simple, right? So any investment is betting on the future, of course, right? So we see a competitive dynamic, we see what's happening today in the markets, and we think, well, Amazon can stay competitive as the online retailer and will only grow from here. You may think, well, companies like Walmart and Target are just not going to give that market away. They will make important moves. And if they make important moves, what will Amazon do? And that may guide your decisions and how you will invest, because you're fundamentally predicting the future. Now, once you do that, and this is where most people fail, they don't have the confidence to make those bold choices. I mean, you've heard all these people, and especially the clowns on CNBC, who say a lot of things, but they don't actually make bold choices. They don't say, this will work, that won't work, this will be successful, that won't be. As an investor, you have to make those bold choices. So you have to be bold, you have to have the fortitude to do this. And when I say the fortitude to make those choices, the real fortitude is to stay with those choices, right? I think a more important mistake to understand is people sell at the wrong time. And I give an example in the book where we talk about, well, just think of Apple or Amazon. When should you have sold Apple or Amazon? Well, never, right? And even when the market was up and down, they've turned into extraordinary long-term investments. So a mistake would be to say, well, I've made 2 times my money, 3 times my money, so I'll sell. But then where do you reinvest? Is there a better choice? And one of the things John Templeton talked about, he was one of my mentors, where Templeton said, unless you can convince yourself there's an alternative investment with at least a chance to return 50% more on the investment you have, don't sell, because you have to redeploy once you sell. So a return is not meaningful without the context of what's a better investment, or as we talk about it, what's an opportunity cost. And seen through that filter, there'll be a lot less selling of good investments and a lot less buying of mediocre investments. So these are complex, they're difficult, and they do require some diversification of thought, but they also require focused choices. And when you make those focused choices, you have to be committed to those choices. And commitment to choice means you've done the work, you've been methodical, you have a conviction. You may be wrong, and you're allowed to change your mind, but be wrong about things that can be shown you're wrong. Don't just change your emotional state. You have to be wrong analytically. And then fine, people make mistakes, and that's fine. So you have to think about, am I performing well? Well, that doesn't matter. It's the inefficient decisions. It's I've performed good enough, so therefore I'll just take some chips off the table. That is not a good idea. Always stay involved with the fortitude to the choices you make, and only change your mind when there is objective and dispassionate analysis that shows you should change your mind. And always remember, the market's going to be irrational, and you're